Hey everybody, Brandon here. In this video, I'm going to walk you through how buying an existing business can set you up and be financially free overnight. So we're going to be going over 4 detailed steps on how to identify the right business for you, whether that be the niche, the business model, or just the right type of business in general. Next, we're going to be going through how to handle your due diligence, which is a vital step to this entire process, because if you do that wrong, you just threw away all your money. The third step is going to be creative financing, whether that be through seller options, SBA loans, things like that. We're going to go over the positives, negatives of some of those, see what the one that matches the best for you. And the final one is setting up your business once you have purchased it for automation. Now that's the key, because if you take a business and just let it run as is, it may work perfectly fine. But a lot of businesses, especially smaller businesses, do not have automation set up, documented process, all the way down to every single thing that everybody does. And trust me, your team will thank you when you purchase that business. Simply following these 4 simple steps can have you financially free almost entirely overnight. So I know you're probably thinking, why not do I just build my own business? Well, you can. There's nothing wrong with that idea. It requires a lot of product validation, research, things like that you need to make sure your product is ready for the market that you're trying to go into. You understand what your customer profile looks like. You have to understand everything across the board before you actually launch, and then sometimes before you've even written a single piece of code. The problem with this also is there's a high failure rate. You fail enough times, eventually one will succeed, and that will be the one that makes you successful. But the problem is, do you want to skip that step or start something from scratch? So the problem with that is you could do this 2 ways. Starting your own business, buying an existing. They both have positive and negatives, right? One of the positives though is that if you have a little bit of cash, let's say 20,000, 30,000, 50,000, 10,000, you have a lot more options. And you're buying an existing business that has already proven it works in the audience it's directed towards. So really your option is reducing fat from different parts of the business, as well as automating and getting the right people in place helps you scale. So me personally, I have had success building my own businesses, whether that be from Shopify platforms, SaaS applications, things like that, as well as buying existing. Now, they each have their own challenges, but they're unique to each other. So a lot of the headaches with startups, you don't have to worry about when you've purchased the business. However, once you've gotten past that point, all the rest of the businesses are going to have the same problems. You need to be able to work on scale. You need to be able to work on process. You need to be able to work on where your money's going, your revenue intakes, which revenue streams are you working with, collaborations, partnerships, all that stuff is going to have to come anyway, but you're skipping the headache of the starting process of trying to figure out, is the product even going to work in the first place? And that's why buying an existing business works overnight and the profit's already running in every single day. So the process itself is actually relatively simple. However, each of these components, I'm going to do a high-level overview. And if you definitely want me to make a mini series out of this, or to create each of those sections into their own video series, go ahead and like and comment below and let me know, and I'll be more than happy to make sure that happens. So when you first start looking at identifying a business for purchase, you want to select your niche. And no, I don't necessarily mean pet care or household items. That's not the niche I'm talking about. I'm talking specifically about the type of business model that you're the most comfortable with, that you know the most about. So examples of this could be software as a service, SaaS companies, Amazon FBA, subscription companies, Amazon KDP for books, audiobooks, Audible. There's plenty of different types of business models, but you want to understand which one works the best for you, which one maps the skill set you have. And it's okay to not have a particular preference or particular skill set. Which one is the most interesting to you? You're going to learn more about the topic regardless when you either look into it or buy the business itself, but you want to make sure that it's something that you're going to enjoy. So for me personally, I focus on affiliate and content, sort of like blogs, for example, or SaaS applications. Amazon FBA has been on my to-do list. However, I am most versed in the SaaS space. I've built the software myself, so I understand the process, I understand the launch, I understand the running. That's just where my skill set lies. However, it wasn't there overnight. It was something that had to be developed over time. A lot of research, YouTube videos, things like that. All of it helps. You'll never go wrong by adding more knowledge to your repertoire. So in this example, we'll use a fake business that is worth $100,000 and it's for sale at exactly 100K. We'll use even numbers. I'm not a math person, so we'll go with that. We'll do 4,500 in profit, 8,000 in revenue, and we'll say it's a SaaS type of business. So that'll be the example that we'll use going through this rest of the process. So now that you've ironed out a business model, the next important part is, where do you find the business in the first place? Now, there's always a good answer of, you can go through friends, you can go through contacts, but you may not have that on day one. So there's a few places that I have personally used. Empire Flippers is number one. The unfortunate part is they are cash only, so we'll go over that in creative financing. BizBuySell is another really good one, and Quitelight are another good one. Both of those last two will work with SBA, and you should be good to go from there, but we'll talk about financing in a second. So it's important when going through those platforms that you take a look at all of the information they have. It's okay to reach out to the business owner. It's okay to ask them questions. One of the important things during due diligence is you want to look at your profit and loss. So you can generally get all that information without ever having to contact the seller, but you will have to contact them at some point. Get on the phone, email, text message, whatever it ends up being. So in our example, we'll use the SaaS business that we found earlier. Company A, let's call it. So now that you've identified the business that you want, you've done initial research, you've taken a look at them, this is the one you want. So due diligence is your next step, and it is the most critical step. There is only one step that I would think is more important than due diligence, is going ahead and smack that like button, subscribe for more content just like this. So due diligence is extremely important. Without that, you have no idea whether or not the seller made up numbers, lied about what the process looks like, their customer count. You don't know anything about whether or not it's true or false. And it's not unheard of for business owners to puff up some numbers, add a little fluff here and there to make it look better because the evaluation is way higher. So it's important to go through this due diligence step. You want to look at your profit and loss statements. You want to look at their customer count. How many are trials versus paid? There's sometimes where 50, 60% are trials, but they're marking it on a profit and loss statement as 600, 800, 1,000 users at 20 bucks a month, let's say. But in reality, it's more like 30 users, 80 users. Traffic is another vital component when you're going through your due diligence period, specifically when you're talking about any online presence company. Brick and mortar has a little bit of giveaway, but they'll need their business profile, what traffic is going through their business profile on Google, for example. But most other online companies, which is generally where I've been focused at, is traffic, right? You want to make sure the traffic is good. The traffic history is good. The backlinks are good. It's not an all-encompassing guide, but there's 100 different things you could look at through due diligence. And if you'd want me to make a video on that in more detail, go ahead and let me know in the comment section below. It's a critical step. And if you mess this up, it could cost you all the money you just spent. It could cost you the loan that you just got. It could put you in a world of trouble because you want to make sure it's not on a decline. So generally, what I've noticed is a lot of business owners are looking to sell when they've got other projects being worked on. And normally what happens is the business that you're looking at buying has just been sitting idle, right? Nobody's touched it. Maybe they've got ads running in the background. That's generally it. Those are good ones to get. You just want to make sure you understand the reason of why there's any decline. And normally it's fairly easy to tell whether it be traffic or whether it's the user count, churn, whatever it ends up being. It'll be fairly obvious during your due diligence period just by looking at just a few of those items. So you found a business that you like, in the niche you like, the type of business model. You have identified the due diligence. You've done things. Everything looks good. Congratulations. You just went through the hardest step. Now, arguably, the easiest step is, how do you pay for it? You got to pay for it now, right? The business owner is not going to hand it over for free. So how do you do this? Well, the easiest way is cash. You know, if it's $100,000, you put $100,000 down, you're done, right? That's pretty much it. However, that's not the case for a lot of us, right? A lot of us don't have $500,000, $100,000, $30,000, $80,000 just sitting around in the bank account. So I'll give you a few other options to kind of handle this process. So if we use our cash example, let's look at our return on investment, or ROI. So pure cash, $4,500 a month in profit, $8,000 in revenue. That brings us to what? 54-ish% return on investment each year. So you'll make your money back in a little under 2 years. That's not bad for pure cash, right? It's really not. And all the profit goes to you. However, just doing different type of financing instead of paying pure cash gives you a much higher return on your investment. So one of the more popular options is an SBA 7A loan. Now, this loan entirely is meant for a few things, right? You could do business acquisitions, which is what this is. So you can buy all the assets with the business. You can buy equipment. You can buy just general cash capital to be utilized for payroll or anything else. So you got a lot of options with that. However, the difference being is that when you're looking at an SBA loan for purchasing something for your business, it needs to already be operational. They're going to evaluate your revenue, your profit, your expenses, things like that. But that only really works if you got something. At the moment, we don't. right? We don't have any business. We're looking to buy one. So the SBA does allow for purchasing of all business assets. Now you'll have to create your own LLC, S Corp, whatever you want, and then they'll transfer the assets to you. You generally don't want to take over the current LLC because you don't know what operational agreements they've got in place, what stocks they've given out to other people in equity. You want to make sure that you get a net new and you can control the entire business from the ground up. So let's use the SBA as the example. SBA has a minimum of 10% down, which is not hard to do if you have a mildly decent 80 and higher credit score, give or take. It depends on the lender too, which bank you go through. But if you have a good relationship with your bank already and they fund SBA, that's the person you want to go to. Utilize that relationship. So on $100,000, 10%, that's 10 grand, right? That can be off a credit card, that could be off equity line of credit for your home, it could be just cash you've saved up. That's it, 10 grand out the door. So that leaves us with a $90,000 loan at, let's say, 10% interest, which is what SBA is generally looking at right now at the end of 2020. Again, depends on credit score, but we'll use 10% as an example here. And generally the loans, you can go up to 10 years. So we'll look at 10 years on top of that. So the payment on that would be $1,189 a month. Now that sounds like a lot, but remember, your business is making $4,500 a month. So it's coming out as an expense of your business, not out of your W-2 pocket for what you do for your normal day job. So if we take the $4,500 minus our SBA payment, that leaves us with $3,311 in profit each month. So the ROI on that is 397%. You make your money back the first year immediately. That's how powerful that is. By the way, there's not normally a limit on SBA loans for how many you can have because the SBA loans are attached to the process and the business you're already buying. They're not attached to you as a person. You are attached to your name and everything so that when you look up, the SBA knows that you have 5 SBA loans, but they're evaluated based on each business. You can have 10 business and 10 SBA loans. So you got your $10,000 back. What's the next thing you do? Grab another business. Now you've got 2. That make you what? Assuming it's an identical business in a different niche, what, 6 grand? That's enough for most of us to pay all of our expenses and no longer have to work for anybody else. SBA loans take about a month to 2 months to close. So you do it twice a year for your first year. You don't got to work anymore. That's how easy it is overnight with just using $10,000. So for those of you familiar with the BRRRR method for real estate, it's a very simple process that way. You're just reusing the same money over and over and over again as long as your ROI makes sense. One important piece with the SBA loan is to understand that they guarantee 70% of the loan with the lender. So the lender has a significantly less risk on your loan because of that. That's why they're a lot easier to try to get the process forward. SBA likes to have collateral, like if you've got a car, if you've got a house, things like that. They like to make sure that their money is safe, and that may be part of your process. It just kind of depends, but I've been able to work through the process without any collateral either. So it does just entirely depend on what you've got at the moment, but know that collateral is not a requirement. The other half to this is you have to remember, similar to real estate and a lot of other things, like most of our time as, non-business owners, when you go to the store, you purchase something, you can't negotiate the price or how you're going to pay necessarily for, your groceries, right? You can't go to the cashier and be like, hey, I don't want to give you $100, I'll give you like 70, and then I'll give you $30 over like the next 3 months. Like, they're not going to do that. But remember, when you're buying a business, everything is negotiable. As creative as you can be, as long as you can agree with the seller on that, all's fair, right? And a lot of people forget that all depends on how creative you want to be, right? If you want to talk to the SBA and say, I want a $50,000 loan instead of a $100,000 loan, well, great. Cool, that's fine. The SBA will then want 10% of your 50 grand, but you talk to the seller and be like, hey, I will pay you over the next 12 months, the last 50 grand, a certain amount a month. That's it, done, over 2 years, a year and a half. Maybe you give them, the SBA does $70,000 and you finance 30 with the seller. Like, the amount of options are almost endless. You can give them royalties, you can give them, keeping them a percentage of the company. Like, there's any number of things that you can do, and it's all about how you present that offer to the seller. As long as it's attractive for them and it matches what their goal is, if they need cash, things like that, they want to move into a different thing, they don't want to work on it anymore. The point is you need to understand why they're selling in the first place, and then the creative options can just flow to you. It all depends on how creative you can be. What deal do you want to structure? That's the point. As long as you can get both parties to agree, you've got it in writing, you're good to go. So the last part of this is you bought the business now, you did your creative financing through loan, through cash, through seller financing, whatever you want to use. You've done that process. The business is now in your hands. Step 1, make sure the business is exactly as they said it was. Make sure all the numbers match. Do the profits and loss match? Traffic numbers match? The actual effort hours to run the business match? Are there actually employees that they said they were employees? What type of employees are they? Make sure everything is exactly as you expected it. That's your first 2 weeks. Because generally, like if you worked with Empire Flippers, for example, if something's not right in the first 2 weeks, they hold the money. So you can always negotiate with them on getting it back and getting partial back. And there's a bunch of different ways you can kind of go about that. But that's your very, very step one as soon as you acquire. Now, step two is you need to understand that business. Understand what process they have and what they don't have. What software are they using? How does their go-to-market work? How do they launch new product? How do they launch new features? You want to be understanding every part of that process. And while you're doing that, make sure you document that process. Your next team will thank you. As you hire people or take over employees, that team will thank you when you've got everything down on paper. Make sure everything is on paper. Every document, every process, how they answer tickets should be on some sort of documented process. That will help you determine on which part of the business you need to scale. And that's this last part, is scaling that business, right? You can buy it and just let it ride, right? But we're in this to make more money than what we started off with. So that same $100,000 business, let's say you bring the revenue from 8,000 to 16, and now your profit's 10. Now your business a year later could be worth $250, almost $300,000, depending on the multiplier, right? That's just you adding a little bit of scale. And then if you sold it, you'd walk away with $200,000 on top of the money you made while you were running the business in the first place. So it's important to set yourself up right for scaling. If you don't understand every piece of the puzzle to the business you just acquired over the next 2 to 3 months, you're not going to scale it as easily as you want to. But key one is documentation. Get that in place. Know what software is in place. What software can be overlapped with each other through a single pane of glass, right? There's plenty of software out there that combine 4 or 5 different things and show you in one view. And there's plenty of other software that does those 4 or 5 things all by itself. So you need to make sure, where do you cut the costs? Software can be expensive every month. So you want to make sure you're getting the right software that does the right part of the process and is able to do all the things you need it to do with as much compactness as possible. That will save you so much time and so much money. Generally, your first 6 months are going to be more about improving process and performance rather than actual pivot changes, direction changes. You want to make sure you got that pulse check. If you don't, you're going to run yourself into so many problems, because you're going to try to solve problems that you didn't even know were existing in certain places, or you're going to try to solve problems that don't actually exist over there. So it's important to make sure you set yourself up for scale. And one of the reasons why I strongly suggest compiling your software down is because that gives you an idea of what sort of extra acquisitions you can make. And what I mean by that is, if you find a software that's doing X, Y, and Z, so all 3 items, as you're growing, what business can you acquire that does all 3 of those things as a software, right? You want to start thinking in that sort of scale as you buy your first business, because then your acquisition for your second will then feed in to the needs of your first, and then the needs of your first feed into the needs of your second as a customer, or even potentially in other ways. That's a whole different topic that we could talk about on scaling into multiple business that intertwine with each other to eventually bust them all up across the board that you can sell as a portfolio later if you want, and then go retire on a beach if you want to. So the point is you want to start thinking at a scale 1 click above wherever you think you're supposed to be thinking. Always click 1 above, look at it top down, because that's when you're going to really start seeing, where's the performance here? Where's the performance here? What do I need to change here? What do I need to change here? What do I need to hire over here? Am I doing too much of this time? And that's how you scale. That's the easiest way to do it. I can make a whole video on it. Just let me know if you guys want to see that. But scaling is a very interesting part of business that a lot of people don't get to touch until they really start getting the ball rolling. But in reality, it needs to be done way sooner than what most are suggesting. So essentially, utilizing this process can help you eliminate your 9 to 5 entirely overnight and give you the financial freedom you want. The key is like, buying a business is also important that you're buying a job for yourself, right? The difference is, with this job, you get to make the hours, not somebody else. You clock in when you need to, when you want to. But it also is true that a lot of people say entrepreneurs will work more than when they're on their W-2, and that's fine. However, the difference is, let's say you work for a month on your W-2, and you're gonna get the same pay. Maybe you get a raise at the end of the year. Great, but if you worked a month on your business, you could be 3 or 4 times what you made the last month, 1.5 times. You're always growing. So the time investment that you make early on will get you to the point where you don't have to make that same investment a year from now. That's not always the same with a W-2. One important note is, post-COVID, real estate's all over the place, right? I'm a big proponent of real estate, and I think it's very important to have in your portfolio, but right now, online businesses are thriving, right? So there's a lot of opportunity to create something new. There's a lot of opportunity to purchase something. People that started a business that want to move on to bigger and better things, it's time for you to take that over, right? All you need is a little slice of the pie. So thanks again, guys, for watching. Hopefully that was helpful. Like, comment, subscribe. Let me know what you guys want to see next, and have a good one.